Welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. Now we're going to be mixing technicals with fundamentals today, and definitely the heavy point is expected to be the Fed's interest rate decision later on. For the time being, you're having in front of your screens Euro USDs for daily chart to narrow it a little bit. So let's talk fundamentals first. It's the Fed's day. But before the Fed, we have the release of the US CPI rates. They're for May. And actually, with forecasts showing rather stubborn inflationary pressures within the US economy, should they be realized, then we may more or less see a hardening of the Fed stance. So expect volatility to start possibly from the release of the US CPI rates later today. That would be the first stop. Should, on the other hand, the forecast fail to meet the actual rates fail to meet expectations and slow down considerably, then we may see a weakening of the US dollar, as the release may imply that inflationary pressures are on curb once again and may ease a little bit the Fed stance. Now, the Fed decision as such is in the late American session. And the event could be broken down practically into 5 elements. The first element would be the interest rate decision as such. Now, the bank is widely expected to remain on hold. Fed funds futures imply a probability of 99% for such a scenario to materialize. I would be noting here that we have Fed funds futures also implying a rate cut in September and a second one in December. Now, there was a little bit of wobbling over the market's expectations about how many cuts the Fed would have within the year. And it was interesting to note that the wobbling began practically after the hotter than expected employment data for May, which were released on Friday. At some point, the market tended to push the possibilities for the first rate cut to be in November, not September. And even at some point, there was some ambiguity whether there will be a second rate cut or not in December. Nevertheless, as time progressed, cooler thoughts tended to prevail, and the market now once again expects the bank to remain on hold today and proceed with a rate cut in September. We have also the meeting of August in the middle, which is to remain on hold, and deliver another rate cut in December. Now let's proceed to the other 4 elements of the decision. The second element would be the forward guidance in the accompanying statement. Should the bank actually maintain a hawkish tone, which would be indicative, say, from a relative decisiveness that it will be curbing inflationary pressures within the US economy as it's set out to do, then we may see the market's expectations for a possible rate cut in September being disproven, or at least being shaken. And that in such element could strengthen the US dollar. The third element of the decision is expected to be the new dot plot. Should Fed policymakers actually show a predisposition to keep rates high for longer than what the market expects, that would be another element which could provide some support for the USD. The third element, albeit a bit weaker in my opinion, but still it's quite important, would be the Fed's projections. Should, say, for example, the Fed expect the CPI rate to remain high for longer, or imply some stickiness in its projections, that would be another signal that the Fed may be keeping a hawkish stance for a longer period and could more or less provide support for the USD. Last but not least, we are highlighting Fed Chairman Powell's press conference later on. It's about half an hour later than the release of the interest rate decision. Now, the Fed Chairman has to juggle, or to balance if you prefer, on the one hand, between the defending of the Fed's interest rate decision as such. On the other hand, he may want to minimize any market effects of the decision. So I would expect that we may see the volatility for USD pairs being prolonged. So be on your watch not only for the time of the release, but also for the duration of Fed Chairman Powell's press conference. Fed Chairman Powell has been well known to be able to switch the market's mood. So we may see one initial reaction at the release, yet that reaction may alter at the time of the press conference. The release as such, in total, is expected also to have ripple effects beyond the FX market. And I would be highlighting three areas here. The first would be definitely US stock markets. The second would be gold. And the third would be oil. And should the Fed maintain a hawkish stance, or at least be more hawkish than what the market expects, then we may see the decision weighing on your stock markets. And the main reason why is practically that should the Fed imply a tight financial environment, a continuance of the tight financial environment beyond the market's expectations, that may make the life of US businesses more difficult, especially in the manufacturing sector, given also that we had a contraction of economic activity for the past month, as implied by the ISM manufacturing PMI figure. And hence, we may see the release weighing on your stock markets. As for gold, I would be noting that gold's price displayed a clear negative correlation with the US dollar on Friday at the release of the US employment report for May. That was very, very obvious. We had a hotter than expected US employment report which supported the USD, yet at the same time sunk gold's price. Should we see a similar behavior by the US dollar later today at the Fed's interest rate decision, I wouldn't be surprised to see the reverse market reaction on gold. So should we see a hawkish Fed, which could provide support for the USD, that could weigh at the same time on gold's price. Last but not least, I would be noting oil prices. And I'm highlighting oil prices in the sense that should the Fed maintain a hawkish stance, that would imply tighter financial conditions or financial environment for the US economy, which in turn could weigh on economic activity of the manufacturing sector and ultimately weigh also on oil demand. And such a scenario may cause the market to start selling oil and thus dropping its price. So having mentioned that, on a technical basis against the euro, we see euro USD bouncing on the S1 1.0730. The support line seems to be holding its ground, and we may see a relative stabilization, but we note that a number of moving averages have started to point downwards. And I would also be noting here that despite a slight correction higher, the RSI indicator remains clearly below the reading of 50, which highlights the possibility of a presence of a bearish predisposition among the pairs traders. Should the bears maintain control, or let me rephrase that. For the time being, we tend to maintain a bias for the sideways motion to continue. And the sideways motion most probably will be between the S1 1.0730, which has proven its worth, and the R1 1.0790. We're talking about the corridor of about 60 pips. Should we see the bears taking over, or if you prefer, for a bearish outlook, we would require a clear breaking of the S1 1.0730 and the price action to aim, if not actually breach, the S2 1.0670. Such a scenario would allow us also to draw a downward trend line, which would be showing us also the limitations of the downward movement of the pair. On the flip side, should the bulls take over, we may see the price action rising, breaching the 1.0790 and aiming, if not even breaching, the R2 1.0840. That should sum it up for Euro USD for the time being. I wouldn't have many expectations on the Euro side of the pair. Maybe some slight hawkishness on behalf of ECB policymakers who just scheduled to speak today could provide some slight support for the Euro side. Yet, the main catalyst behind Euro USDs and any USD, any major pairs movement today is expected to be the Fed's interest rate decision. Now let's have a look at USD JPY. USD JPY, which tends to edge higher. You can see 1, 2, 3 small green candlesticks. On the other hand, we can see how the pair remains shy of the 157.75 resistance line. That's the R1. So we tend to maintain a bias for the sideways movement to continue. But allow me to clear the chart from any prior trend lines. Here you go. So we have seen that the price action since around the 8th of May remained in the corridor formed between the S1 154.55 and the R1 157.75. You can see that in the highlighted rectangle in your screens. And on the other hand, though, we have to note definitely the upward channel within the boundaries of which the pair has been moving since the start of the year. So more or less, once again, we tend to maintain a bias for the sideways motion to continue, yet bullish tendencies cannot be excluded. Should the bulls take over, we may see the price action of USD JPY breaching the 157.75 resistance line and start aiming for the 160.20 resistance level. That's a level which is marking an over 30-year high, if I'm correct. So it's a critical level. And in my opinion, any breach of the R1 could be a signal for BOJ and the Japanese government to actually intervene in the markets once again. They did it before last month, so I wouldn't be surprised to see them doing it again this month. So be on the watch for that. For the time being, the RSI indicator has been rising. It's edging higher than the reading of 50, implying that a bullish sentiment is building up. Mind you that on the fundamental level, should the Fed's interest rate decision actually support the US dollar, we may see the pair USD JPY actually breaching the R1 and start aiming for the R2. On the other hand, we have also to note here that after today's interest rate decision, BOJ will be releasing its own interest rate decision on Friday. And that could create additional volatility for the pair. However, we will be analyzing that tomorrow. Let's have a look and see how the Fed interest rate decision is going to be affecting the pair. And then we can talk also about BOJ. Let's have a look at GBP/USD cable. Now, cable, this is the daily chart. Allow me to readjust it a little bit so we have a clear picture. Here we go. Cable, interestingly enough, over the past 2 days and during today's Asian and European session, remained in a slightly upward trajectory, yet the big picture remains that the pair remains in sideways motion, locked in between the R1, 1.2805, and the 1.2680. Financial releases tend to, I wouldn't say surprise pound traders, and especially on the UK side. On the other hand, though, we can see that any shocks are being quickly absorbed by the market. It was characteristic how we had the release of UK GDP rate for April, and the rate slowed down to stagnation levels, 0%, as was expected. So that should not be a market mover because exactly it was expected. But there was a surprise on the manufacturing and industrial output growth rates. Also for the months of April, they contracted deeply. And in my opinion, that tended to darken the economic outlook of the UK by a shade. So that's an issue. On the other hand, though, let's see the market reaction at the time of the release, drilling now to the minute chart, unlocking the chart, widening it, and here you have it. You can see how the pair dropped at the minute of the release, but only by 8 pips. And it quickly recovered and lost ground and moved decisively higher later on. So the financial data of the UK, back to the daily chart, left pound traders unfazed, and the price action remains in a sideways motion, unable to breach or even test the upward trend line. So we have conflicting forces here. On the one hand, you have the resistance line, the R1, which tends to limit any upward movement. On the other hand, you have an upward trend line which has started since the late days of April. Let's verify that. Yep, since the 22nd of April. And it's highlighted by an upward trend line which tends to push the price action of cable higher. For a bullish outlook, though, I would require a clear break of the 1.2805. We would require practically a higher peak than this one, and the price action to start aiming, if not breaching, the 1.2890. On the other hand, should the bears take over, which is a possibility should the Fed sound more hawkish than what the market expects later today, then we may see the price action of cable dropping, breaching the upward trend line. That would be the first signal that the upward movement of the pair has been interrupted. And it would be also a signal to abandon the bullish outlook. However, for bearish outlook, I would also require the pair to breach the S1, 1.2680, a level which provides support once, 2, 3 times here, and start aiming, if not even breaching, the 1.2560. It would be a huge drop, I recognize that, but the Fed's interest rate decision is an event which could actually produce such volatility. Let's have a look at USD CAD. Now, USD CAD seems to have hit the ceiling yesterday at the 1.3785. It was very briefly breached. It was a false break, in my opinion. And the pair seems to show some signs of stabilization. The RSI indicator remains above the reading of 50, but is slowly dropping, which may be implying that the bullish sentiment of the market for the pair is fading away. And definitely, I would require a higher RSI for a bullish outlook here. For a bullish outlook, we would require the pair to breach the R1, 1.3785, and start aiming for the R2 1.3895, nothing less. And the Fed's interest rate decision could provoke such a result. On the flip side, should the bears take over, we would require the pair to breach the S1 1.3690 and start aiming for the S2 1.36. It wouldn't be an active aiming, it would be more like paving the way. Unless we have a substantial market reaction against the USD side of the pair, which could allow the pair to drop exactly at the S2 or even lower. Let's have a look at AUD-USD. Now, AUD-USD has breached yesterday, that was since Monday. There have been some bullish tendencies, and the R1 0.6660 has been breached, so we have to switch this into support line. And I think if we drill into the 1 hour chart, that would be more obvious. You can see how that has provided support in the past 24 hours. Back to the daily chart. Let's readjust the labels. Starting with the R3, which is now being placed at 0.6870. The R2 at 0.6780. The R1 at 0.671. The S1 at 0.66. The S2 at 0.6515. And the S3 at 0.64. Let's have a look now on what the prospects are for the Aussie against the US dollar. Once again, we're highlighting a possible bullish effect for the USD side of the pair from the Fed's interest rate decision, without excluding any bearish tendencies. That's another scenario, though. On the other hand, on a technical level, I see some hesitancy on behalf of the bulls to actually proceed. And I'm mentioning this because the RSI indicator has reached and remains near the reading of 50, implying a rather indecisive market. So for the time being, the bullish outlook is there, yet is very, very weak. We would require for a bullish outlook a heavy bullish response for the USD side of the pair. So for a heavy bearish response for the USD side of the pair, which would allow AUD-USD to rise, aiming, if not breaching, the 0.6710. On the flip side, should the USD side of the pair actually gain, then we may see the pair breaching the S1 0.66 and start aiming for the S2 0.6515. For the time being, though, once again, note the flattening of the moving averages, note the RSI indicator, which remains close to the reading of 50. All of that tend to imply some sideways motion. Let's have a look at WTI prices. By the way, before we move to WTI, a little bit back to the Aussie. We have mentioned the USD side of the pair. There are, though, fundamentals also for the Aussie. And those would be the release of Australia's employment data for May. We're getting some mixed signals from the forecasts. And the mixed signals stem out of the fact that The employment change figure is expected to drop, yet remain in the positives, while the unemployment rate is expected to tick down. The first element would be weighing on the Aussie normally, or at least theoretically, while the second element could be providing some support for the Aussie. Should we see a deviation from the forecasts and possible alignment towards improved employment data from the Australian market, then we may see the Aussie getting some support during tomorrow's Asian session. Vice versa, should the data align and imply a loosening Australian employment market, which could add more pressure on RBA to start cutting rates rather early than later. Mind you that forecasts are for the bank to remain on hold throughout the year. Then we may see the Aussie weakening and AUD/USD falling during tomorrow's Asian session. Commodities market, WTI. Now, WTI's price seemed to show that the bulls took a break, and today's Asian and early European sessions tend to highlight the bullish possibilities for the commodities price. And at this point, I would clearly draw an upward trend line. It's very steep, and that may allow oil's price to start aiming for the 180.10, if not breach it. Now, before we move to the technicals, let's talk a little bit about fundamentals of the oil market. And we have three issues. The first is the Fed's interest rate decision, yet we have mentioned that and analyzed it already. I would also be noting here the release of AP's weekly US crude oil inventories figure. That was yesterday in the late American session, early Asian today. And the release showed a decrease of US oil inventories, a drawdown. And that tended to imply that the US oil market seems to be tight. However, that release, or if you prefer, the tightness of the US oil market, in my opinion, would have to be first verified also by EIA in today's weekly crude oil inventories figure. Should we see another drawdown, implying that once again demand surpassed production levels and created a small void in the US oil market, then we may be talking about a tight US oil market, which could provide some support for oil prices. The third element I would be noting here would be the release of OPEC's monthly market report, but also IEA's monthly oil market report. And we're getting some conflicting messages here. On the one hand, you have OPEC. OPEC's report more or less showed that the organization is sticking to its guns and is expecting a robust demand side for the oil market until the end of the year, maybe trimming forecasts a little bit in quarter one. And such an demand outlook, tends to be supportive for oil prices, as that would imply that a robust demand could push oil prices even higher. On the flip side, we had the release of IEA's monthly oil market outlook. And at that point, or at that release, we show a slightly different picture. IEA seems to be expecting a drop of 100,000 barrels per day in the demand side of the US oil market, which may be trimming the gains for oil prices, maybe causing some hesitancy among oil bulls. So we have a couple of elements which would be of interest for oil traders, not only today, today, concluding today. Let's not forget that tomorrow we are to release our weekly oil report, which is going to be containing all of that. For the time being, on a technical level, we tend to maintain a bullish outlook. Expect the price action to reach or breach actually the R1 80.10, and basing our bullish outlook practically on the upward trend line, which is guiding the commodities price higher. At this point, it would be interesting to note also that the RSI indicator has recovered from the depth of the readings of 30 and has reached now and slightly surpassed the reading of 50, which more or less tends to imply that any bearish sentiment has faded away from market participants for oil prices. Yet, in my opinion, the fact that the RSI indicator is still at the reading of 50 does not imply a buildup of bullish tendencies among oil traders. I would like to see RSI indicator rising even further. That would be supporting our case for a stronger bullish predisposition of the market for oil's price. In any case, should the bears take over, we may see the price action of oil dropping, breaching the pre-mentioned upward trend line exactly in a first signal that the upward movement has been interrupted. Yet for a bearish outlook, I would also require the commodities price to breach the S1 7665, and that may prove a little bit difficult given that we had 1, 2, 3, 4, 5 times where the level supported the commodities price was finally breached here, but yet once again breached to the upside. So should the price action drop, break the upward trend line, break the S1, and start actively aiming for the 7150, then we may be talking about a possible bearish outlook. Let's have a look at gold's price as well. Readjusting the chart a bit. There you go. So we have gold's price, which edged higher yesterday, yet the bulls are quite hesitant after hitting a ceiling at the $2,320 per ounce price. So that's a resistance level which tends to be quite solid for the time being. Should we see a strengthening of the USD due to, I would say, a more hawkish Fed, that could weigh on gold's price and may push it below the S1 2277, allowing it to start aiming, if not testing, the 2227. Let's not forget that we had a market reaction on Friday to the downside for gold's price, which was pretty heavy. We're talking about $103. And I wouldn't be surprised to see a similar market reaction in today's Fed's interest rate decision. So the size counts in this case. At the same time, such a movement downwards would allow us to draw also a downward trend line like this, showing us the limitations of the downward movement. And in any case, for the upward movement to emerge, that would imply that the price action of gold has to breach the 2320, breach the downward trend line, breach also the 2363, and start aiming for the 2400 resistance level, which for the time being is quite extreme. Okay, let's have a look at US stock markets. I would look at Nasdaq. The upward movement is being maintained. The price action is nearing the 19,300 resistance line, albeit timidly. We have to note that. It seems that there is some hesitancy on behalf of the bulls to actually breach the R1 and start aiming for the R2 19,900. And that's understandable, as the market may be on the watch out about what the Fed has to say later on today. Now, should the bulls maintain control, we may see the price action breaching the R1 and start aiming for the R2. On the flip side, for a bearish outlook, we would require tumbling of stock prices, which would be breaching the pre-mentioned upward trend line, breaching the S1 18,500, and start aiming for the 17,800. At this point, I have to note that boys at research tended to highlight another outlook, which is a little bit wider. And it would go like this. In such a case, it would be very, very difficult for the price action of Nasdaq to breach the bullish mood. For the time being, though, I tend to rely more on the second upward trend line. Let's have a look also at Dow Jones. Dow Jones, which has hit a ceiling on Friday at the 39,140, remains confined in a very slow market motion between the R1 and the S1 38,000. We tend to maintain the bias for the sideways motion to continue, and we're basing that practically also on the RSI indicator, which remains close to the reading of 50, implying a rather indecisive market. On the other hand, though, we have to note also that the Fed's interest rate decision could alter the index's direction to any direction. It could go either up or down. And in that case, we may see the price action, say, for example, in bullish market reaction where the Fed is less hawkish than expected. We may see the price action of Dow Jones breaching finally the 39,140 and start aiming for the round figure of 40,000. On the flip side, should the bears take over, I would expect the price action of Dow Jones to drop, breach the S1 38,000, and start aiming for the 37,100. Anything which maintains the price action between the R1 and the S1 allows the sideways motion to continue, in my opinion. Last but not least, let's have a quick look at S&P 500. S&P 500, which has breached the reading of 5,325. It has even provided some support at some point here. So that tends to be now a support line. And we're placing the new ultimate resistance line at 5,625. I'm moving in a pretty narrow path here. I understand that. The bullish outlook seems to remain present and seems to be supported. Allow me to correct also the labels. Now, the bullish outlook is being supported practically by two elements. The first element is definitely the upward trend line, which has been guiding the pair since the early days of April. Sorry, the index since the early days of April. And the second element would be the RSI indicator, which tends to remain or continue to aim for the reading of 70. It's pretty high and tends to imply that there is still some bullishness, substantial bullishness, among market participants for the index. On the flip side, should the bears take over, which does not seem to be the case right now, but it's still a possibility, then we may see the price action of S&P 500 actually dropping, breaching the 5,325 and also breach the upward trend line, signaling the end of the upward movement, and practically start aiming, if not even breaching, the S2 5,235. Ultimate support line is set at 5,116, yet that remains a very distant target for the index's movement. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Webinar. So today we'll be on to our third part of our trade management series on idea and validation. Okay, so as per usual, before we get started, just a disclaimer and risk warning. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So, disclaimer, the information in this webinar should not be considered investment advice and or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We'll do a brief recap on the first two parts of our trade management series. So that would be the anatomy of a trade, take profit, stop loss placement, partial profit, and then we'll get into this week's concepts on idea and validation, and I will go through a couple of examples. So once I'm done with the slides, then we can look at a couple of live analysis charts. So feel free to pop in any of your requests for any currency pairs or commodities that you guys would like me to go through, and I'll be happy to go through them after I'm done with my slides. Okay, feel free to pop in any questions you have into the chat as well. Any questions at all throughout the webinar, and I'll be happy to answer them as well. Okay, so let's go ahead and get started. So firstly, we have anatomy of a trade. So of course, you have the basics, your entry, whether you are going in for a sell entry or a buy entry, you still have to pick a level of entry, followed by your stop loss levels as well as your take profit levels. Okay, and then we get into our trade management part of the trade, which is the break even, the partial profit, trading stop losses, as well as idea and validation, which is what we'll be going through today. So just a recap of where you should place your take profit as well as stop loss. So firstly, we have, in this example, we are looking at a buy sell entry, as you see, because our take profit is a support level over here. right? So our entry will probably be somewhere in the middle here, and then we're going in for a sell towards our take profit. Okay, so for this example, our take profit is placed before or above our major resistance area, whereas our stop loss is placed above or beyond a major resistance area. Okay, so maybe I'll just show you guys I'll just show you guys some tips and tricks if you are a beginner and you're just starting out. Okay, so you can look at the Forex Army. So we have a couple of guides over here. Okay, you can look at the trading guides. Ooh, okay. So if you're not too familiar with Fibonacci as well, we have a pretty in-depth explanation here. Okay, and just some pretty basic but important things to take note of if you're just starting out with technical analysis. So over here, we are focusing on Fibonacci, but let me show you. Yeah, so this is typically what we recommend. Okay, even, oh, okay. So even if you are talking about a major resistance area, it doesn't have to be a Fibonacci confluence per se, just as long as it's a major resistance area that you have identified. Okay, you would place your take profit before a big confluence area, and then your stop loss will be placed beyond it. So in this example that we're looking at, we're going in for a buy entry. So you can see this is how we typically would recommend you to place it. So your take profit would be right before your major resistance area. Your stop loss would be under it. Okay, whereas in this previous example, since we're going in for a sell entry, similarly your take profit will be before, but in this case it would obviously be above the major resistance area, and your stop loss area would be up above it as well. Okay, since it's beyond the major resistance area. Okay. Okay. Yep, so you can go ahead and take a look at this website. Feel free to explore. We have some examples, some trading guides for you to take note of, and support and resistance, some MT4 installation guides as well. Okay, and trading tools. So you can go and explore that on your own. Okay, so next, this is what we went through last week. So last week we went through break evens and partial profits. So if you missed that, I'm just going to briefly go through what exactly a break even and partial profit is. So starting off with break even, it's a level where you are in profit and recognize that there is a risk of reversal, which means there's a chance that price will hit back to your entry or even worse, perhaps your stop loss, right? So it's basically you saying that if I'm right, price will go all the way to my target, but if I'm wrong, I will get out. Okay. So here in this example, our entry level is this blue line here, and it's in line with this double swing high resistance area. So this is our entry level because price has broken out of this swing high resistance. Okay, wait, let me just make sure that okay. Okay, great. You guys can see my screen. Okay. So, what was I saying? So price has broken out of this double swing high resistance, and this is our buy entry level. Okay, so it's testing this level a bit, and then you can see that it's triggered our break even level, which is at this swing high level. Okay, so it's triggered this level and it's reversing back to our stop loss, or rather to our entry. So originally this level here is our entry, but then and our stop loss is way below over here, right? But because we noticed this reversal, because of this break even, right? So once price is reversed off of the break even, then we want to quickly move our stop loss over to our entry. so that even if price does reverse back down, at least we get out of the trade at break even and protect our position. Okay, so if in this case it doesn't really affect your take profit because at the end of the day your take profit is still here at this green highlighted area. So it doesn't affect anything in terms of your take profit, but it protects your position and it ensures that even if price continues to rise to your take profit, then of course that's great and you would make a profit. But even if it reverses back down, which it is threatening to do, since it's testing our break even level, our position is protected over here. Okay, so here's a example from a chart. So our entry level in this case is a swing low. Okay, at this is at this swing low at 0.68314. Okay, and we are noticing that we do have a Fibonacci projection level. So Fibonacci projection, I'll go through it a bit during our chart analysis, but basically you're looking for a flash kind of shape. So you see here, there's like a lightning bolt shape, okay? And for that, we use 61.8, 78.6, as well as the 100%. And we're noticing that the 100% Fibonacci projection lines up with our entry, okay? So we're expecting price to bounce off of our entry and hit towards our take profit. Our stop loss is placed at this swing low and our take profit is placed at this swing high here. Okay. So over here, we're noticing that we have a couple of levels that are lining up with our partial profit. Um, okay, that are lining up at this level. Okay, so this level is what we call our partial profit, and I'll get into that a bit. But basically, we see this 23.6% and this 38.2% Fibonacci retracement are lining up nicely. Okay, so we're labeling that as our partial profit that's somewhere in between your entry and your take profit. So we see that price has nicely reversed off of our entry, just as we expected. Okay, and it's headed towards our take profit, but it's currently touching our partial profit. Okay. So now what we do, since price has already touched our partial profit, we saw with our break even, we're moving our entry towards our stop loss. So this way even if price reverses off of our partial profit, which could happen since this is a confluence area. Okay, confluence area basically means that if there are two or more Fibonacci levels that are lining up in that same area, that just basically makes it a confluence area. Especially because at our partial profit level here, we have two swing lows at this level as well. Okay, so that makes it a pullover um, resistance level as well. Okay, so we could see price testing this level here. And yeah, so we are moving our stop loss to our entry so that if it does reverse, we can get out at break even. But we've also made partial profit over here. Okay, and if you see over here, price actually did reverse off of our partial profit level and it reversed and it headed back down to our entry and stop loss. So this way we got out of the trade at break even and even with actually a little bit of profit. Okay, I hope this is clear. Okay, now let's take a look at idea invalidation, which is our focus for this week. So idea invalidation it's usually placed before your stop loss level. Excuse me. So it's usually placed before your stop loss, and it's the level which you basically admit that that your initial trade idea was wrong and you want to get out of it ASAP. Okay, so idea invalidation, or rather invalidation, basically refers to the whole process of testing the validity of your trading idea or your hypothesis. So be it whether you are going in for a buy or a sell. So it involves analyzing the market data, market conditions, and then in order to determine whether the idea is likely to result in profits or not. So if the analysis shows that the idea is unlikely to be profitable, then it's considered invalid, and then you as a trader may choose to discard it or modify it. So the goal of idea invalidation is to reduce the risk of making poor trades and increase the chances of success by only pursuing valid and well-researched trading ideas. So um let's go through this example here. Okay. So in this case, we are placing our idea invalidation below our stop loss line here. Okay. And our entry is at similarly at this swing high, double swing high resistance. Okay. And we're going in for a sell entry. Um, yeah, we're going in for a sell. And we're hoping for price to drop all the way down to our take profit over here. Okay, so notice how previously I mentioned that we place our take profits before major confluence areas. So in this case, we have three swing lows that line up nicely. So this is typically considered to be a major support area. Yeah, so that's why we place our original take profit or our take profit before that level. Okay, so so we're seeing price nicely reverse off of our entry as we expected, and it's heading towards our take profit. Now we see it reverse and it's actually heading back up towards our entry. And the point where we decide that we want to get out is at this idea invalidation part. Okay, so at this idea invalidation, then we will quickly move our take profit in this case to our entry. So previously we were moving our stop loss to our entry for break even, and now instead of that, we are taking our take profit and we're moving it to our entry instead. Okay, so it's pretty similar in logic, just that we have different names for it, I guess. And yeah, and it's basically the point where you admit that you're wrong and then you move your take profit to entry so that it gets you out of a losing trade. So you can see in this example that we were able to get out of it at break even before price rose and further and would have stopped us out. Okay. So idea invalidation refers to the process of evaluating a potential um trade idea and determining if it should be disregarded or acted upon. So essentially, it's a way of determining if a trade idea still holds up in light of new information or market conditions. Okay, so here's how the process of idea invalidation typically works in trading. So firstly, you will have the initial trade idea, and the trader has the initial idea would be about a potential trade that's based on their analysis of market conditions, technical indicators, or other factors. Next, we have evaluation of the idea. So the trader has an initial idea about the idea, right? So then they will evaluate the idea by looking at current market conditions and other um relevant data, okay, such as economic data to determine if the initial trade idea still holds up. Now, the invalidation criteria, the trader then establishes criteria for invalidating the trade idea, such as specific price levels or market conditions that would cause them to reconsider the trade. Next, we have monitoring. So, of course, after moving your stop loss levels or your entry levels, or your take profit levels rather, then you would have to monitor the market and the security in question to see if the invalidation criteria are met. And then invalidation. So if they are met, then the trader may choose to either exit the trade or adjust your position in the ways that we've mentioned earlier. Okay, so if the criteria are not met, then obviously the trader might continue to hold the position or you can even add to it. So let's look at some examples on the charts. Okay, so firstly, we have our entry. Okay, so our entry is at this swing low here. Excuse me. So our entry is at this swing low here, and our take profit is placed at this overlap level. And overlap level is basically when there are bulls and there are bears that are respecting that area. So basically when there is a swing low as well as a swing high that line up in the same level. Okay, and we see that this level also lines up with a 50% Fibonacci retracement. Okay, so we've decided to place our take profit at that level, and we're expecting price to reverse off of our entry and hit towards our take profit. Okay, so it's heading down towards our entry. Okay, now this is what we call a Fibonacci extension. Okay, so the 127.2% is a Fibonacci extension, or what we call a Nike tick. So I'll get into this in a little bit. But basically you are looking for the shape of a Nike tick. As you can see over here, the V shape is inverted. So this is an inverted Nike tick shape. So we're the 127 lines up with a minus 27.2. And this minus 27.2 is what we call a Fibonacci expansion. So for Fibonacci expansion, we are looking for, like the Fibonacci projection, we're looking for flash shape or a lightning bolt shape. Okay, which you can kind of see over here as well. So our minus 27.2 lines up with this 127.2. Okay, so this is an area that we are keeping an eye out for and placing our stop loss below. Okay, so our stop loss, as I mentioned earlier, we place our stop loss beyond any confluence areas. So that's why we're placing our stop loss not at that level specifically, but below it. Okay, and we're noticing here as well that this 50% Fibonacci retracement also lines up nicely with a take profit. So we have two levels lining up with this overlap level at our take profit, which makes it pretty significant. Okay, now our idea invalidation level is placed exactly at that level since our stop loss is placed below it. Okay. So now we see price has broken out of our entry. Okay, it hasn't really bounced off of our entry as we expected it to. In fact, it broke out of it and it actually dropped towards our idea invalidation. Not as low as our stop loss yet, but our idea invalidation level is definitely triggered. Okay, so what we do now is we move our take profit to our entry. Okay, so this way we can minimize losses and get out of a losing trade. So you can see here, we're moving our take profit to our entry. Okay. And then once price has continued to rise from our idea invalidation level, okay, it's rising to our take profit level or our original entry level, and we got out at break even. Okay, and you can see if we had continued to place our take profit over here, right, we would have gotten stopped out. Okay. Okay, I think that's it for my slides. Now we still have half an hour left. Now let's take a look at some charts. Feel free to pop in any requests into the chat. Let me just take a look at let me just open my charts. Okay, let's see. Okay, we can take a look at AUD. Okay. Okay. Yeah, let's go ahead and take a look at AUD on a weekly time frame first. Okay, so on a weekly time frame, we see that the Aussie dollar is kind of moving in this descending trend line. Okay, so it is pretty bullish on a weekly time frame. If we look at the daily time frame, it does look pretty bullish as well. We also have a descending trend line. Okay, we might even have a trend channel here. Okay, we kind of do have a descending trend channel as well. Um, Basically, for a valid trend channel, you need to have at least two touches on top and two touches below. Okay, at least. Okay, now let's look at 4 hours. Or actually, on our daily time frame, let's plot out some levels that we want to take note of. Okay, so this will be my first resistance at this level here. And then my first support maybe just here. And this is a overlap level as well because we have a swing low here. Ooh, okay. So this is the reason why we want to pull it back as far as we can so that we can see how many times price has tested this level before. So I have one swing high here, swing low here, and a couple of swing highs here as well. So pretty significant level there. And next I'll just place my second support below here. Okay, I have a question. How do you trade the news? Um, okay, so some one way that you can trade the news. Let me just show you what we like to use. So you can, firstly, obviously, you would probably have to make use of a economic calendar. So there are a lot of economic calendars out there in the market. One that we like to use is Forex Factory. So I'll just show you guys Forex Factory, I guess. Can you guys see my screen? Yes, okay. So yeah, so I like to look at Forex Factory and then you can take a look at all of the news events for the week, apply settings. Okay, and I am only looking at the high impact events here. Okay, but you can click on this green filter here and it'll give you all of the low, medium, and high impact events. And you can control which currencies you're looking at as well and the different event types. Okay, so tell you the previous data release, the forecasted release, and then once the data is actually out, it will also give you the actual value. So you can see all of the events for this coming week over here, just at one glance. If you're interested, there are a couple of forums as well, so you can take a look at investor sentiment as well as other traders' thoughts. And then you can look at the news from the different news articles and news outlets. And yeah, that's basically how you trade the news. Go ahead and read up on whichever that stands out to you. If you are trading euro, you could maybe look at or maybe AUD, let's say. Right? So we had the cash rate yesterday and the cash rate was released at 4.35%, but the forecasted was the same, the previous value was also the same. So we can see how this exactly impacted the markets. Okay, so we can see 2:30 p.m. on Tuesday. So we can see, maybe we'll take a look. 2:30 on Tuesday. Let's look at our 4-hour time frame instead. What's going on? Okay. Sorry, I'm not sure what's going on with my laptop. Okay, got it. So 2:30. Oh, okay. Because this timing is um the timing is a little bit different. Okay. On my trading view and on my Forex factory. So it doesn't really link up. But if we look at the Tuesday, we can see how it impacted the charts, and you can see that price dropped over here and then started to pick up again on Wednesday. But this is on the 30-minute time frame. Okay. I don't think this had much of an impact since the actual data that was released is similar to the forecasted as well as the previous. But things like mm, if you look at the CPI, maybe if we look at Swiss franc in a bit, it was slightly lower than the forecasted. So we can look at how that impacted as well. But yeah, that's basically how you can make use of the news to trade. Yeah, feel free to just copy the names of whichever news event that you're looking for into Google and then look for um, an explanation on what you are expecting, what the investor sentiments are about um, the investor sentiments, but of course also the governments, um, what they are expecting to do as well. Okay, yeah. Uh, yeah. Let's get back to our 4-hour time frame. Okay, so I'm going to place my first resistance here, and then my first support maybe just here. And then I think I'll place a first resistance, an intermediate resistance here. Yeah, so if you look here, it'll give you a list of all of the events that's happening for the week. If you want to know more in depth on each of the stories, you could maybe look at um, some of the um, news articles from this list here, because these are pretty up to date, like 1 minute ago. But of course, take all of these with a pinch of salt because it's from different news outlets around the world. So you can take a look at those over here, or you can, like I mentioned, just Google some of these events. No, these happen weekly. So it's it's throughout it's every basically every week. So depends on your trading strategy. So what I'm talking about now is a weekly time frame. So I'm looking at all of the news for that week. Yeah, I hope I'm understanding your question. Okay, so this is my intermediate level of resistance here. Um, Now let's go in with some Fibonacci levels. Okay, so I have a 23.6% Fibonacci retracement that lines up with my intermediate level. Uh, let's see if we have a projection. No. Okay, I have another retracement here. Okay, my 38.2 lines up nicely. Um, 38.2 maybe, yeah, 38.2. So my 38.2 lines up with my first support. Let's see if we have anything else. Okay, my 61.8 Fibonacci projection lines up with um, my first resistance. Okay, so they don't really have to line up exactly because these tend to be areas more so than levels, than specific levels. Okay. And I personally don't like the 0 and 100% because I find it a bit messy. Okay, so let's go in with our indicators now. So I like to start off with MACD and Ichimoku because at one glance you can see exactly what the signals are. Okay, so price is moving below the Ichimoku cloud, so it's giving us a bearish signal. And on our MACD, it's also giving us a bearish signal, which matches our analysis. Okay, and let's see another RSI maybe. Okay, RSI, we have price moving in a descending trend line. Okay, so it's also supporting our analysis. Okay, it's not really a trend line, but you can see over here that um there is a divergence. Okay, so over here price has made a higher high, and over here price has obviously made a lower high. Okay, so that's a bearish divergence. Also supports our analysis, and maybe let's look at Bollinger. Okay, Bollinger isn't really telling us much. Let's look at stochastic. Okay, stochastic isn't telling us much either. Okay. Okay, so we're going for a sell from this intermediate resistance towards our first support. And if you're looking for maybe another sell, could go perhaps even until here. Mm, okay, because price has tested this level many times in the past, as you can see. So price is typically attracted to such strong areas of resistance or support. In this case, of course, support. So once price breaks out of our first support, we should have enough downside confirmation that price will continue towards our second support. Okay. Yep, I can pop in the website over here. It's just Forex Factory. Yeah, so this is just for you guys to look at, all of the weekly news events or however long you want that's scheduled for that week or month. Okay, okay, let's look at another chart. I think I mentioned earlier that we'll look at Swiss. Oh, okay. So let's start off by looking at our weekly time frame. You can see it's also pretty bearish on a weekly time frame. On our daily time frame, it's pretty bearish as well. Let's look at 4 hours, also pretty bearish. Okay, and we typically would recommend to continue to follow the trend. So if it's a downtrend, then we will go in for a sell. Uptrend, of course, we're going for a buy. Okay, this is my first support, and you can see once again it's an overlap level of support. Um, okay, and here I have my um yeah, here I have my first resistance. Okay, maybe I'll put a second resistance here as well. Okay, so now I am going to see if I have any retracement levels that line up. Okay, and I have my 23.6 and 30.2. Let's see what else we have. Okay, my 61.8 also lines up nicely. Mm, okay, my 100% 78.6 kind of line up as well. Oh, okay, but it's no longer valid because price has already broken past these levels. Okay, so earlier I mentioned a Nike tick shape, so I just want to show you guys an example. So as you can see here, this is an inverted Nike tick. A upright Nike tick will look something like this. So you want to make sure that price surpasses 100% of the head of the tick before you use this method, this Fibonacci extension. Okay, so for Fibonacci extension, we use the levels that are greater than 100. Okay, let me get rid of this. And okay, we're using a retracement, and then we use the levels that are greater than 100%, so the 161.8 and 127.2. Okay, and you can see that it lines up nicely with our second resistance and first resistance, but because you can see that price has already broken past these levels, so these are not valid. Okay, just wanted to show you guys an example of that. Okay, now let's look at some indicators. So price is moving below our Ichimoku cloud, so it supports our bearish bias, and our MACD is giving us bullish, so we're going to remove that. Let's look at RSI. Um, RSI is giving us bullish. Okay, so let's remove that. Let's look at stochastic. Okay, stochastic is kind of not telling us anything. Let's look at our moving averages. Okay, price is moving above our SMA but below our EMA. Okay, so it's bearish on our EMA but not our SMA. Now let's look at Bollinger Bands. Okay, it's bouncing off of the top band or the upper band of the Bollinger Band. So it does support our analysis. Okay, I think that's it for this chart. So we're going in for a sell from our first resistance towards our first support. Okay. Okay, I think that's all the time that we have for today, but let me know in the chat if you guys have any other questions. Um, Let me just make sure I've answered all of them as well. Okay. Yeah, I think that's it for today. I hope you guys found this session helpful. And yeah, have a great rest of your week, and I will see you guys next week. Bye, everyone.